Welcome to Highrock Capital Private Client Services. My name is Scott Tomlinson, and I am one of the two managing partners at Highrock. I'm going to walk you through an introduction to Highrock and a few of the key concepts behind what we do for our private clients. Highrock was originally founded by our other managing partner, Paul Tepsich, in 2010 to manage 4 funds for Scotiabank, and Highrock is registered with the Ontario Securities Commission. I joined Paul over a year ago to help build our private client business. We are excited to have our unique business model already making an impact. Our clients are coming to us because they trust in our patient, no-nonsense approach to low-cost investing and wealth management. Why Highrock? Well, we started the private client division as a vehicle for investing our own money and invited those who have similar investing philosophy to join us. Our money is in the exact same models as our clients, so we have a vested interest in protecting our capital and yours and finding the best risk-adjusted returns to get the appropriate growth. Our team has a combined experience of 73 years and the highest levels of education in the industry. More on that in just a moment. We are obsessed with providing the optimal in client service with open and regular communication while upholding the highest standard of fiduciary duty. We are at all times available to show you all of your costs, both our fee and any hidden embedded ETF management expenses. What does it mean to be 100% employee owned? Well, Paul and I each own half of the outstanding shares of the company. As I stated at the outset, our money is invested in the exact same models as our clients. We are completely in this together. You are investing alongside of us and our experience. We do not have a mandate to gather assets and farm them out to other portfolio managers, as many advisors do. There are no conflicts of interest, sales managers, or revenue targets like many banks and investment firms. Our mandate is the one our clients give us. It is the stewardship of their wealth. Our team each have the highest level of accreditation available in the investment industry. We all offer complementary skill sets to bring you the best possible combination of assessing your wealth needs and goals and developing the appropriate strategies to achieve them, managing your wealth, your risk, and your financial future. As I mentioned earlier, our resumes are deep with experience. Trading billions of dollars in securities with various banks and investment dealers has taught us a great deal about the management of risk. Not many investment advisors have this kind of background. At Highrock, you start with a wealth forecast prepared by our certified financial planner professional that will identify your goals and allow us to tailor a long-term strategy to your specific needs. This is followed by a portfolio strategy that is executed with disciplined, active, and tactical portfolio management, which you likely do not get with many advisors. We also have my almost daily blog and our weekly webinar to keep you current on our thinking, quarterly reports, semi-annual reviews, and as much interaction with the portfolio's managers as you wish. Very few fund managers, if any, will talk directly to their clients. When markets get volatile, we want to be in touch with all of our clients individually to let them know that their portfolios are going to be okay. Because we care, and we really do care. That is why we are in this business, because we enjoy looking after you. A client said to me the other day, "Scott, my work is my hobby. I come to you so that I can focus on my hobby, and you can look after my money." Well, our work is our hobby, so it makes us a good fit. Our private client division was established to take advantage of some of the synergies that come with the funds that we manage for Scotiabank, with over $100 million in assets. We are not stockbrokers. We're not investment advisors or financial advisors, or salesmen who farm their clients' money out to other portfolio managers, like Highrock. We are a portfolio management company who has a clear understanding of wealth management. Our structure allows us to pass on our lower costs to you. And importantly, as I've said before, because all of us at High Rock have our own money invested in the same models as all of our clients, whatever we do for all of us. Our interests are aligned with yours, so there is no conflict of interest. Our fees are simple and transparent, and we fully disclose any hidden or embedded fees. And that is something that may not be the case with most advisors. In fact, we keep our costs down because we do not outsource portfolio management as many advisors do. As we have come through a cycle of above average portfolio returns over the last 6 or so years, we have entered into a period of below average returns that will likely bring us back to the average. This being the case, it is really important to pay attention to the costs of investing. And fees truly matter. If you look at the impact of fees over time, it can be astounding. Every year you need to have at least a 1% better performance just to justify some of the fees. And more importantly, you need to ask yourself what you are paying for. Over a long period of time, the additional costs can compound and significantly impact your outcome. Over 10 years on a $1 million portfolio, you're paying your advisor an additional $200,000 if you are in a standard advisor model. That becomes $700,000 over 20 years and more than $1.5 million over 30 years. That's a lot. It's easy for an investment advisor or portfolio manager to get you fully invested after you sign up with them. They sell the securities that you had and put you into the investments that they want you to have, and they do it immediately at whatever prices are available at that moment in time. That is easy work for the advisor. It is a great deal more work to pick the right purchase points. Sometimes it may require patience and some explanation. In fact, some assets may take months and even years to get into a portfolio. This is where our experience becomes crucial. As a result, risk management becomes very important because we must be vigilant not to put our clients' money at greater risk in order to chase higher returns in the short term, but take a long-term view to make sure that clients get invested at the appropriate time. Part of the discipline that we bring to the table is in picking the appropriate price points for buying new assets. This is part of the value that High Rock adds to our client portfolios. There are many risks that we have to focus on an ongoing basis. Our goal in managing all of these different types of risk is to reduce the overall volatility of our portfolios. We call this achieving the best possible risk-adjusted returns. We want to have the highest returns with the lowest amount of risk or volatility. Having spent years managing multi-billion-dollar portfolios at Merrill Lynch and other investment institutions, we have learned how to manage all types of risk. Our ongoing efforts for the management of your portfolio strategy is to find the best possible returns while simultaneously providing the least amount of risk in doing so. Naturally, this is done in the context of each of our and our clients' specific goals, tolerance for risk, and time horizon as we determine in your wealth forecast. Our research shows that a globally diversified and balanced 60% equity, 40% fixed income model has significantly reduced risk and still achieved a strong annualized return over a multiple year period. Better risk-adjusted returns than the S&P 500, the TSX, or even the preferred share index. A rebalancing on a regular basis is crucial. Different asset classes will outperform or underperform at different times in a market cycle. Selling the outperforming assets and buying the underperforming assets will continually add value and return. Underperforming assets will eventually return to better performance, while outperforming assets will ultimately underperform. This is how profitability is realized and new cash reinvested. Here's an example. In December of 2015, we decided that because Canadian equities were the worst performer of the developed nations, that it would be a good time to add value by increasing our percentage weight in Canadian equities. At the same time, because we felt that the S&P 500 was overvalued, that it would also be beneficial to take profit in our holdings and reduce exposure to this particular asset class. As of April 26th, Since the beginning of the year, the TSX, including dividends, has had a total return of better than 7%. Meanwhile, the S&P 500, including dividends and currency adjustment, has had a total return of almost minus 6%. That is a net return of a positive 13% on that rebalancing. That is another way we can add value to your portfolio. Our discipline is our strict adherence to your goals-oriented investing, our structured models, protecting your capital, regular rebalancing, in-depth research, fiduciary responsibility, and a very high level of client service, which includes ongoing monitoring and a review with you of your wealth forecast to determine if we are meeting our targets. If we are not, then we will make the appropriate adjustments to make sure that you are going to successfully achieve your goals. The trust that you place in us is not taken lightly. Fortunately, in our years of experience, our years of experience have brought us many favorable reviews. We post these on our website under the Trust and the High Rock Difference tab if you want to read them in greater detail. We follow the highest code of ethics and fiduciary responsibility. We fully disclose our fees and any embedded costs and above the regulatory requirements. We contract a compliance expert to provide an independent review for our clients and send it out quarterly with the quarterly performance reports. We have continuous and regular communication and avail ourselves for one-on-one discussions if you wish. There are very few firms in the investment industry with portfolio managers who will do this. At High Rock, we have three models with which we can create balance and diversification. A fixed income model with government and investment grade bonds. A small percentage may be high yield corporate bonds, and we may include a selection of preferred shares here as well. We have a global equity portfolio that focuses on diversification across thousands of companies in multiple economic sectors and across many geographic locations. As well, we have a model that focuses on Canadian small to mid-sized companies with which we have a great deal of familiarity and deep levels of research. This is an active or tactical model intended to obtain better than average growth by seeking out companies that we believe are trading at prices well below their value. For example, we bought Rona shares for our tactical model late in 2015 because they looked cheap. A little while later, in early 2016, Lowe's thought Rona shares were cheap as well, and they bought them all, paying almost double what we had. Now, of course, our clients reap the benefits. More added value for them. We use these models to create portfolio strategies that are, of course, in keeping with your desired goals, risk tolerance, and time horizon as is determined by your wealth forecast. Based on that wealth forecast, we can create any combination of our three models to match your particular portfolio strategy needs of balance and diversification. For example, my strategy of 60% equity and 40% fixed income is built with 50% of our global equity model, 10% of our Canadian tactical model, and 40% of our fixed income model. Paul's portfolio is made up of 25% global equity, 25% Canadian tactical, and 50% fixed income. Now, depending on your needs, a more conservative portfolio might consist of 35% global equity, 5% tactical, and 60% fixed income. It really depends upon what your wealth forecast determines would be the best strategy for you. We will tailor this strategy very specifically to suit your needs. Your accounts are held under your name at Raymond James, one of the largest wealth management companies in North America, who provides custodial and back office services for High Rock clients. They are your accounts and your securities. You just give us permission to make the appropriate trades in them. Raymond James is a member of the Canadian Investor Protection Fund, which covers customers of members who have suffered or may suffer financial loss as a result of the insolvency of a member. so your accounts are protected for up to $1 million per account. If you would like to learn more about HighRock Private Client and discuss any of this in more detail, please feel free to contact any of us by phone or email using this contact information. Well, thanks for taking the time to listen in, and I hope that we hear from you soon.